This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Caution prevails as investors reduce risk ahead of the Fed decision. Policymakers are ready to hike interest rates to the highest level in 22 years. From tech to autos, earnings season is in full swing. We're going to break down the latest AI hype from Alphabet and Microsoft, plus speak exclusively with the CEO of Stellantis as cost-cutting lifts profits. And Deutsche Bank weathers the trading slowdown better than expected, while NatWest CEO Allison Rose resigns following a political controversy. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, it says a lot when the Fed is the least interesting story. Before anyone gets mad at me, of course, is important. But look, it's not the most volatile, surprising thing we've gotten today.
No, it isn't, but I'm sure it will be in a couple of hours, certainly as we're watching the bond market really position for that. Remember, look, 25 basis points is what's on the table here, priced into the market. The big question is what kind of precedent does it set? Because remember, Goldman Sachs specifically coming out and saying that their house call is essentially that the Federal Reserve is going to alternate between a pause and a hike. We're on the hike's turn. Do you start to see Chairman Powell say, we might need to pause yet again? That's going to be really the sticking point when it comes to what the Federal Reserve is thinking, in addition to all, of course, their macro feedback. The way it's translating to the market this morning, though, really has more to do with earnings than it has to do with the Federal Reserve, specifically NASDAQ 100 futures, of course, coming off of the Alphabet and Microsoft earnings, down about 0.2%. But remember, there was this big buildup going into those earnings as well. So how much of this, Dani, is positioning, of course, as we are in the last week of the month as well. So some rebalancing flows there to keep in mind. Two-year yield 4.85, again, ahead of the Federal Reserve, down about 2 basis points. So you are seeing the bond market catch a little bit of a bid, at least on the front end of the curve, a smaller bid as you go further out. Perhaps taking with it the dollar as well. You are seeing some broad weakness in the dollar, but a good chunk of that is coming from strength in the Japanese yen. Now, remember, we are going to hear from the BOJ later this week as well, and that is going to be crucial when we talk about how they are going to perhaps follow up with their yield curve comments earlier this week, front-running that a little bit. But nevertheless, dollar-yen weaker by about 0.4%, 140.34 on that currency pair. And of course, gold. What's interesting here is that as yields are coming down, gold is actually higher. So how much of this is a kind of store of value trade, Dani? 1972 on the precious metal.
It does feel like it's summer markets, which, to your point, Kriti, makes today's decision by the Fed even greater chances of volatility. If we're not seeing tons of volume coming through, that's especially true in Europe. Not a lot of excitement. The euro is barely changed, just slightly stronger versus the dollar. The excitement, Kriti, it's all under the surface. It is all about earnings. I picked out two specifically for us because they're one of the biggest movers to the upside and downside. The biggest mover to the upside in the Stock 600 this morning is Rolls-Royce. They, of course, no longer make cars. This is the engine maker. Good news for them. They're able to lift their profit forecast because we're all traveling. Sure, there's concerns about European consumers, but we're happy to pay up to go on flights still. So Rolls-Royce up some 20%. It's its highest level in about 3 years. Meanwhile, one of the biggest losers to the downside, and it's absolutely the biggest loser if you take into account market cap, is LVMH, falling almost 4%. Their earnings were after the bell yesterday. The big disappointment was the American customer. Those organic revenues falling 1%. Kriti, we established you didn't buy Van Cleef. You didn't help out Richemont. What's up? Are you not buying Celine either? You and your American friends not helping LVMH out.
I know. It's almost like we have to deal with inflation and a lower real wage. It's pretty astonishing. How dare we not help out those luxury brands? But let me tell you, there are going to be a lot more movement from perhaps some of the bigger players, not just in the consumer space, but in the corporate space as well, which brings us to Alphabet and Microsoft reporting their second quarter results, both focusing on the growth of AI. Take a listen to what Alphabet CEO Sundar Pichai said on the earnings call.
We are making sure we develop and deploy AI technology responsibly so that everyone can benefit. Last week, we signed on to joint commitments with other leading AI companies at the White House, building on the principles that have guided our work for many years. To take advantage of the AI opportunities ahead, we've been sharpening our focus as a company, investing responsibly with great discipline, and finding areas where we can operate more cost-effectively.
Joining us now is Matt Bloxham of Bloomberg Intelligence. Look, perhaps some differing messages when it comes to Alphabet versus Microsoft. Matt, I want to start off specifically with the Alphabet story here. Talk to us about what we learned. What was the most surprising to you?
Well, I guess what was maybe surprising but encouraging to investors was that there was strength across the whole suite of revenues, and in particular their search platform, which is the core of everything that Google does, surprised to the upside. You know, there's strength in the advertising market for them. Things like the ChatGPT haven't really yet made any inroads into that core business. And I think it also speaks to how brands think about advertising. You know, in an environment where they're having to cut back on budgets, they still stick with the platforms that they know and trust to deliver them results. And Google Search is very much that platform.
Yeah, short Snap advertising, long Google advertising is what these earnings feel like. What about Microsoft, down 4% in the pre-market trade? Is that more about the stock price run up more so than the actual results?
I think so. I think it also does speak to this kind of hype around AI, and the reality is it's going to take quite a few quarters for the AI revenue growth to really kick in. And so as they announced last week, these new Copilot products for Microsoft 365, so AI extensions to Excel and Google and PowerPoint, things like that. But it's going to take a while for that to kick in. And there's also, in the interim, there's going to be more investments into their cloud infrastructure to make those services possible. So I think it's kind of patience for investors before you see those revenue benefits start to kick in.
Yeah, and I wonder how much of this was really traded ahead of time as well. We were kind of expecting a little bit of doom and gloom from Microsoft. Perhaps we got that. Matt Bloxham of Bloomberg Intelligence all over the big tech story. And of course, we go from big tech to banking. Over in Europe, Deutsche Bank kicks off banking earnings, beating expectations amid a trading slowdown. The lender announced a share buyback of as much as 450 million euros. Bloomberg's Oliver Crook spoke with the CFO.
First of all, in our range, which we said at the beginning of the year, 28 to 29 billion, we're now saying that we think we're solidly in the middle, probably the upper end of that range. We think there's a story developing in terms of the non-interest income revenue sources that we have. You know, financial markets over the past, 4 or 5 quarters have been sort of more difficult, but we see that starting to come back, and we think we're very well positioned to take advantage of that.
Oliver Crook now joins us from Frankfurt. Oliver, talk us through the results here. Deutsche Bank, of course, not the only one reporting this morning, Santander as well, but talk us through what you learned here from the Deutsche story.
Yeah, Kriti, overall, pretty positive earnings story here from Deutsche Bank. You know, let's drill down a little bit into the different categories. Asset management, private bank, both sort of in line. And the corporate bank and critically, the investment bank beating expectations. Remember, FICC and trading in particular was going to be the focus here. They had guided it down up to 20% lower this quarter. Goldman Sachs had an estimate down 18% for Deutsche Bank. It came in down only 10%. So that is really sort of a standout beat there, beat a lot of the peers. And what's also interesting is seeing the balance of the business shifting through the interest rate hike environment. You actually had the private bank bring in more revenue than the investment bank. All of this being said, it is not enough for investors this morning. It's down about 1%. That down probably to costs coming in a little bit higher. They're aggressively cutting costs, and maybe that's going to be a little bit more challenging than they had anticipated.
Oliver, we also had some really ugly numbers from Germany, from the German eco story. As an executive who oversees Deutsche Bank, I mean, the German bank, what did you have to say about that and the broader European economy?
Yeah, listen, this is all down to it's a rate-sensitive business, and obviously this is a rate-sensitive economy like every economy. And really, as the lender to Germany Inc., there's been no shortage of bad news, whether it's PMI, IFO surveys, these GDP revisions in and out of recession. Basically, I asked him about that, and yesterday we had the ECB saying that corporate loan demand fell off of a cliff, and he's seeing that in the results. He's seeing that in terms of demand. However, he still believes in the soft landing narrative. He says that is to be expected. Credit conditions he's actually okay with, all things considered. He says there are pockets of weakness, but it's not broad-based, and he does actually expect growth to pick up in the back half and the end of the year. What clients are most worried about, it's no longer inflation, it's no longer recession, it's geopolitics.
Oliver, thank you so much. A really fantastic interview. Bloomberg's Oliver Crook in Frankfurt. In other banking news, NatWest CEO Alison Rose will step down following a row over the way the British lender closed accounts held by politician turned pundit Nigel Farage. Pressure for her to quit had been rising. Both Rishi Sunak and Jeremy Hunt indicated her position was untenable. after she said she spoke to a BBC journalist about the account closures. Let's bring in Bloomberg's Will Shaw for more on this. Well, when I went to sleep last night, it seemed like the board was backing Alison Rose. What happened? What made things turn here for her?
Oh, it was all very strange, and it all happened very quickly. So shortly after 5 p.m., NatWest put out a statement in which she acknowledged having spoken to the BBC about Nigel Farage's bank account at Coutts and why it had been closed. She apologised for that. She said she shouldn't have done it. But at the time, she thought what she was telling the BBC was correct, which was that this was a commercial decision, and she hadn't yet seen the documents that Nigel Farage has released from Coutts, suggesting that they got rid of him after deciding that his values didn't match their own commitment to diversity. In the same statement, the NatWest chairman, Howard Davis, said he acknowledged that Alison Rose had made an error of judgment, but the bank still had confidence in her. At that point, everything went quiet. People thought that's it for now, perhaps. Then suddenly at 1:30 a.m., NatWest put out another statement saying, in fact, Alison Rose would be leaving by mutual consent. Now, the backdrop of this is the government remains the biggest shareholder in NatWest. They've got 39% voting rights in the bank. It's a Conservative government. There's plenty of people in there who sympathise with Nigel Farage and his opinions. People close to the Chancellor, close to the Prime Minister, were briefing after the initial statement from NatWest that Alison Rose really ought to go. So it's very much a political story.
And of course, stateside, we also have more banking news. PacWest, for example, being bought by smaller rival Bank of California. Talk us through the context of this deal. What was the market response here?
So that merger is essentially aimed at shoring up confidence in US regional banks after a run on deposits caused several of them to collapse. The market is very pleased with this news. Shares in Bank of California surged by some 22% after the Wall Street Journal first reported that the pair were in talks. So obviously, this is something that the market did want to hear.
Will, thank you very much. That is Bloomberg's Will Shaw in London. Coming up, Stellantis delivers better than expected results for the first half and says more cost cutting is to come. We're going to have our exclusive interview with CEO Carlos Tavares next, and we're going to push ahead to the Fed decision that comes later today. Anneka Treon, Lanschot Kempen Chief Economist. We got so much to discuss. Stay with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. A lot of earnings to sort through, European automakers being one of them. So we had Porsche this morning. It's currently edging lower. It missed on sales. Now, on the other side of things, Stellantis higher, almost 2%. It reported better than expected results for the first half and said further cost-cutting measures are to come. Joining us now is Stellantis CEO Carlos Tavares. Carlos, thank you so much for joining us. Congratulations. A good set of results. The market likes the results. And clearly there's a lot of excitement over cost cuts and that more are to come. Where are you going to squeeze that extra juice from?
Well, first of all, thank you for having me. It's indeed a very exciting period we are going through, because not only our strategic direction is proving to be the right one, given the results we are achieving, but we also see that the market is becoming more and more competitive, and therefore we need to be aligning our own business model to what the customers are looking for. They are looking for more affordability, they are looking for less emissions, they are looking for a high level of appeal and a high level of quality. From that perspective, I would like just to point out that in the last GD Power survey results, the Stellantis brands took the 3 positions of the podium, number 1 with Dodge, number 2 with Ram, and number 3 with Alfa Romeo. So we are very happy to move in that direction. And of course, if we need more breathing space to adapt to the market conditions, we'll make sure that we continue to reduce our own costs to make sure that we give back to the market the level of affordability that the market is looking for from us.
So would you, for example, Carlos, drop suppliers. Is that something you're thinking of if they can't reduce costs to the level that you want?
You know, over the last 30 years, we have given our suppliers 85% of the added value of automobiles. 85% of the total production cost of an automobile is bought out parts. So we have given our suppliers 85% of that added value. Over the last 30 years, they have enjoyed significant profits and good returns for their investors, and that's fine. And we love that. As a consequence of that, it is also true that when we have to absorb 40% of additional costs coming from electrification, their contribution needs to be a reality as much as we are contributing ourselves from our own plants. So yes, at the end of the day, it has to be a partnership working both ways. It is time now to help the US consumer benefit from electrified, affordable solutions, which means we both have to contribute, we both have to find breakthroughs, we both have to work in a more collaborative way to make sure that the final winner is the US consumer with affordable electrified solutions. That's normal, that's the reality of our industry.
So is that a yes, Carlos? You would drop them if they don't do this plan?
It is not what I mean. What I mean is that they need to be taking examples from what we are already doing. What we see in our plants is that the biggest contribution to the cost reduction of our automobiles is coming from our own plants. So we can support them with the open book comparisons in terms of the methodologies, tools, performance KPIs that we are using to help them accelerate their own cost reduction in a win-win perspective. And the point is, in this Darwinian period, if you don't transform yourself, indeed, you put yourself at risk. It's true for us, the OEMs, it's true for the suppliers. This is a Darwinian period. This is a period where if you don't adapt to a new world, a world of electrification, a world of very strong demand from our customers in quality and in a certain number of attributes, if we don't adapt, then we put ourselves at risk. It's not Stellantis that is triggering that. Yeah. Stellantis is adapting to a new world, and we are inviting our suppliers to come along with us and learn as fast as we are learning for ourselves by showing them what we are doing. And that's the direction, the collaborative direction that we would like to take.
Yeah, certainly an approach I think a lot of the car makers right now are dealing with in the EV space. But Carlos, at what cost here, especially when a lot of the EV plants in the U.S. that Stellantis is building to address that structural change is also not necessarily, according to some, paying wages in the same way that a traditional car maker would, for example. How do you respond to something like that? Is that something you're going to address as you lean more into EVs?
It's a great point, and I think we should answer in two different kinds of ways. One is short-term, the other one is mid-term. Short-term, last year, based on the 2022 results, we paid to our US workers $14,000 of performance bonus. $14,000 of performance bonus. It was the highest performance bonus among the Detroit Three, and we are proud of that, which means that when we create value, we share those results with our employees, and we bring the best performance bonus of the Detroit Three. So we will continue to do that. We'll continue to support our people and make their life better. That's clear. At the same time, where we do this for our employees, we also want to do for our employees all the work that needs to be done now to protect the midterm competitiveness of our US footprint.
Yeah.
And there are a certain number of things that we see in the numbers that we need to do, in quality, in cost, in timing to go to market, etc. So we have our own list of things that we can work on with our union partners to improve the competitiveness of our operations in the US in midterm. So you see, it's a two-fold answer. Short term, we share, we contribute, and we were among the best.
Yeah.
Midterm, we need to work today with our union partners to get that competitiveness. And we have done this everywhere in the world. We have done it in Germany with IG Metall, in Italy with FIOM, in France with CGT. There is no reason why we would not be able to do it with UAW to protect our own employees and improve their quality of life.
Well, Carlos, I appreciate the optimism. I'm so glad you brought up the UAW. We actually reached out to them for a statement, and I'd like to read to you what they said to us. They said, quote, "We encourage Mr. Tavares to come to Detroit and explain directly to his employees how he can justify their receiving a 6% pay increase over the last 4 years while his salary skyrocketed by 72%. Now, Carlos, talk to us a little bit about your response to the UAW. We know that they are also trying to get that equality in cost that you just talked about. What is your response to those labor negotiations?
First of all, being a free man, I don't have to respond to any postering that I could see in the media every day, of course. So please accept that as part of my answer. You know, what I see through my 42 years of experience in the automotive industry is that there is a big difference between the external postering and what is done behind the scenes in the meeting rooms in terms of common work. So I'm not negative. You can have a judgment about what has been said over the last few weeks or months, trying to put pressure on the OEMs. It's a tactic. I can respect that. I'm working for the employees. I'm working to make their performance bonus bigger, and I'm working to make their plants and their engineering divisions more competitive for the midterm and the long term. So I'm working for them. That's my answer. And as long as my salary is 90% based on results, which is 90% variable, that means that if my salary is okay, then the company is okay, and that's my mission. So I'm quite fine with that. And I just would like to challenge my UAW partners to be constructive, collaborative, and open-minded in the discussions we are going to have together. And I'm sure that we can find a win-win for the best interests of our employees.
Well, Carlos, let's then talk about the read-through into the numbers when it comes to your bottom line, Stellantis' bottom line. I mean, at the end of the day, the UAW represents about 15% of your global workforce. If you are looking at those increase in wages as they are looking for, what does that do for your bottom line at a time that you yourself said you're trying to scale up your EV presence, which, as we know, is a costly venture to begin with?
Well, that's exactly the point. You are hitting the nail, which means now you are talking about midterm. So the question is, if we are doing the right things now by bringing those $14,000 in a performance bonus like we did last year and creating a conditions for that number to improve in the future, how do we prepare for that situation to be sustainable within 3 or 4 years? How do we prepare to make sure that the wealth creation within our US operations will be able to fuel that kind of trend? That's exactly what we should be doing, because, of course, any increase of cost has two dimensions. One dimension is a competitive one. How are the costs of Stellantis competitive vis-a-vis the other OEMs in the market? And that's a competitiveness matter for us. And the second one is, does it trigger inflation for the final consumer? Does it make freedom of mobility less affordable for the middle classes? So we have to tackle these things. We could make a short-term decision that has a negative impact on the
Carlos,
jobs and the competitiveness
I love
in the
what you say. I love what you say in terms of this being a Darwinian period. I really think that captures really the essence of what it's like right now. Look, this is a little bit separate, but I happen to be a huge F1 fan. So nearly every weekend, I see those impressive Alfa Romeo cars driving around the circuit. And a lot of Americans like me love it too. Why not try to invest more money in Alfa Romeo and really lift it in the American market? Only about a minute here, Carlos, but what are the economics of that quickly?
Well, that's fantastic. Thank you for making that point. You know, Alfa Romeo is a big success since Stellantis was created. We made a huge turnaround of the business model. It's now a highly profitable brand. It's a growing brand, 60% volume growth on the H1 2023 compared to last year. So it's growing, it's highly profitable. We have turned around. We are happy to be in Formula One, and we are going to increase our presence in the US, including at one point in time.
Carlos, unfortunately, we're just out of time. We're going to have to connect on that later. We've got to talk more F1. Carlos Tavares there of Stellantis. Thanks so much. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Caution prevails as investors reduce risk ahead of the Fed decision. Policymakers poised to hike interest rates to the highest level in 22 years. And from tech to autos, earnings season is in full swing. We're going to break down the latest AI hype from Alphabet and Microsoft. Plus, of course, we just heard exclusively from the CEO of Stellantis talking about cost cutting and those labor negotiations. Plus, Deutsche Bank weathers the trading slowdown better than expected, while NatWest CEO Alison Rose resigns following a political controversy. I'm Kriti Gupta in New York with Dani Berger in London. Dani, 30 minutes into the show, can we officially pivot to Fed talk now? And of course, that is coming. It is Fed Day, but it doesn't necessarily feel like Fed Day.
Kriti, why you got to set me up with that? I literally have a board in front of me with all Europe that literally has nothing to do with the Fed. I'll let you pivot to it, and let me take us through the European trade here. All right, euro. Okay, here's maybe the one asset I have Fed related. Euro versus the dollar. Euro is strengthening, maybe a little bit of caution around the Fed. Perhaps we're buying the euro in anticipation the ECB will be more hawkish, which is entirely possible. I don't see why they would do that because the European data has been so bad, but we know the ECB has sounded more hawkish as of late, so maybe that's how you want to position. European equities overall, they are falling, but let me point out the two standout when it comes to earnings. Rolls-Royce, we were just talking cars. Rolls-Royce not in charge of the car company anymore. This is the engine maker, the UK engine maker, really strong results, upgrading their forecast, considering the travel story still going on, still strong. Those shares up more than 19.5% for the most in 3 years. Meanwhile, LVMH, disappointing results, all about the U.S. consumer. Organic revenue in the U.S. falling 1%. Those shares down 4%. Kriti, when you take into account market cap, easily the biggest downside mover in Europe today.
Well, all right. You started with the earnings picture. You picked the micro. We'll stick with that, I suppose. NASDAQ 100 futures down about 0.1%. But look, it really is coming as a function of those Alphabet and Microsoft earnings that we got last night. Remember, Meta reports after the bell today, so that's going to be something to watch as well. But look, again, not major conviction here. I think what's important to keep in mind is there was major buying going into the earnings and then perhaps a sell-off after, not really being reflected when you look at the index level. Again, this is where I do think the macro kind of steps in a little bit, perhaps a little bit of a wait-and-see approach in terms of rebalancing, et cetera, as we wait for 2 p.m. New York time today. Of course, the Federal Reserve decision coming out, about 25 basis points expected on the docket. Nevertheless, the 2-year yield is lower. You are seeing bonds catch a bid on the front end of the curve. What does that mean in terms of just how close the Federal Reserve is to ending their tightening cycle? Remember, Goldman is talking about pause, hike, pause, hike. Do we see the Federal Reserve follow that call? And what kind of precedent do they set for all the other central banks we're going to hear from in the back half of the week? Nevertheless, 2-year yield 4.85 there, taking with it the dollar as well. The Japanese yen is actually strengthening. We're looking at 140.32 on that currency pair. So the BOJ is going to be in the news and the headlines later this week. And of course, we did hear earlier this week that yield curve control would not necessarily be tweaked. So perhaps a lot of the action when it comes to the yen already baked into the price. And of course, we have to get a quick check on gold, because as yields come down, gold is actually rising. 1971 on the precious metal, a bit about 0.3%. Dani, I wonder how much of that increases or maximizes as we get closer and closer to the Federal Reserve decision this afternoon.
I was really thinking, Kriti, at the start of this week that we should have done a pool to make bets for all these different central bank decisions, but it kind of feels like all of them are really set in stone. We expect the Fed to go 25 basis points today. It'd be strange if they didn't. Option markets at the moment, it's all about what happens after that. They are pricing in a 50% chance of another hike post-July. I mean, we're dead split, but we also have to remember, Kriti, that it's not until September that we're going to get another Fed decision. In between that, we have 2 CPI reports. We have a lot of data. I mean, we got PCE at the end of the week today. I feel like there's so much unknown that we're going to have to face, even after we have this Fed decision in hand. Okay, so that's the Fed, of course, and we're going to discuss that in just a moment. And then after that, we have the ECB. So when it comes to the ECB at the moment, Kriti, the way this market is positioned is in euro that just hit an all-time high. Very, very recently, we had the trade-weighted euro just last week, had an all-time high. We talked about this dollar net positioning is at its most bearish level on record. You got to fear it when this market has a one-sided bet on really anything, Kriti.
Yeah, and I think that euro strength that you mentioned is so crucial here because remember, we are seeing, of course, the talk about the end of the tightening cycle, but at different paces. The Federal Reserve much, much closer to that than some of its peers. Of course, the Bank of England, Dani, you know that. But I think there's a big question here about just how long you see some of the gains or the strength in the currency picture where all of a sudden, at what point do you see the pivot that the BOE is still hiking, the ECB is still hiking, but that actually leads to currency weakness, not currency strength.
Yeah, look, it's a lot of cross currents to keep track of. I'm trying to keep track of it because, again, I got a wedding to pay for in euros, but I'm paid in pounds. I have some money in dollars. My life is a mess. If anyone has any recommendations, I will happily hear them. Let's listen. Let's now get to someone who knows a lot more than me. Maybe can help me sort out my life. It's Anneka Treon. She joins us on the phone, Chief Economist at Van Lanschot Kempen. Anneka, Kriti and I were just talking about the fact that it's not necessarily this decision. It's what comes after this decision that's important for the Fed. But we don't get a dot plot. We don't get a forecast update. So what to you is the most important thing you can learn today from the Fed decision?
Hi, good morning. Well, so I guess the upcoming decision, as you say, is probably going to be a non-event, right? It's already consensual. We'll get the 25 basis points hike, so that will probably happen. But to your point, what happens afterwards? And the latest CPI print being better than expected is certainly helping the idea that we're not going to see lots of additional rate hikes after it. But I think it's all about the following. It's all about what is the attitude and what is the behavior going to be about this official 2% target. Because if you look at the facts, we're still nowhere near the 2% number. Look at core inflation. Look at how sticky it is. Look at how stubborn services inflation is. If the Fed has this attitude that says, look, we've undershot this target for years, and suddenly out of nowhere we're overshooting it, but let's be patient and eventually we'll get there, fine. But if the Fed is going to be very, very strict in order to improve its credibility as well, we're sticking to it and we're going to be extremely hawkish to get there, that could be a negative surprise, and that could trigger the recession that we've all been talking about for so long.
So, Anneka, your take then on the Goldman call, which I think a lot of other banks are hopping onto, the pause hike that you are seeing, perhaps expected by the market. What kind of precedent does that set if the Federal Reserve chooses to go in that route for, say, the ECB, the BOE, as they eventually hit the end of their tightening cycles?
Yeah, well, I guess starting with the ECB. So the ECB is clearly behind the curve versus the Fed. And that's also why if you read the minutes and you look at the language being used, Lagarde is extremely outspoken. We are not there yet. Europe has an even bigger, stickier core inflation problem than the US. And that's why there's simply more to go. And even if the Fed is using more of this pause/skip/raise approach, ECB has to continue its trajectory because, as said, we're simply not there yet. The Bank of England, on the other hand, is also, and it's quite interesting because we were all sort of very much aligned with the central banks across the world. Going into COVID, it was all a very negative rate, dovish policy environment. Then after COVID, that got exaggerated, and then suddenly everybody turned around from transitory. And now you see things start to diverge. And maybe it's because the world is becoming less globalized, who knows? But you see that the Bank of England has been pretty extreme. Inflation has been really out of control. The ECB behind that, acknowledging that they've been too slow, and the Fed furthest along in the curve. So it's quite interesting to see how those, and obviously Bank of Japan is a wild card out there, right?
Yeah, it absolutely is. And of course, we're going to hear from them, I believe, tomorrow. Anneka Treon, thank you as always for walking us through really the global central banking story. Interesting to see now they're diverging. When do they converge as well? Coming up, we go from the macro to the micro, a tale of two earnings. Big tech posting mixed results. More on that with Stefan Slowinski of BNP Paribas Exane. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London with Kriti Gupta in New York. And the enthusiasm around AI was really put to the test. We had both Alphabet and Microsoft reporting their second quarter results after the bell. We're going to get a lot more results this week. Here to help us sort through all of them is Stefan Slowinski, Global Head of Software Research at BNP Paribas Exane. Stefan, First of all, thank you so much for taking time out of your schedule to join us. I'm sure this is maybe, what, the only free breath you can take away from your desk of the day?
Yeah, it's definitely a busy week, but happy to be here. Thanks for having me, Dani.
All right, well, let's pick through some of these. Microsoft, those seem to be the disappointment today. Shares falling about 4% pre-market. They had run up a lot because of AI. Would you characterize these results as a disappointment?
I'd say three things about the Microsoft results. I mean, first of all, the results themselves were very strong. 10% revenue growth, beating expectations by a couple percent, 130 basis points better on margin. Core businesses performing well, Office, Azure, Server, Dynamics. But the second thing I would say is the outlook was a bit soft. The Q1 was a bit light. The commercial bookings didn't grow year over year on tough comps. And on Microsoft Azure, that key cloud computing business, the company didn't commit to a reacceleration there and was a bit vague about when we should see that business stabilize. And there was no real outlook given on the top line for 2024. And then the final thing I would say is they're investing in generative AI. And so margins will be flat this next fiscal year. CapEx will be up. And we think CapEx could grow 40%. 40 year over year.
Wow.
So that's going to keep free cash flow flat, and we think that brings down consensus expectations today.
From a macro perspective, investors are really ready to punish companies that have a higher CapEx, that aren't turning around better profitability. Does this hurt them then in the short run? Is this something that the market is willing to punish or not because it's around AI, which is the shiny new toy for the market?
Yeah, I mean, that's right. This will put that resolve to the test. I think investors will look through this. We see the products. We know that Microsoft 365 Copilot is being piloted by 600 customers. It's getting good reviews. That will be coming. It should drive revenue growth acceleration in fiscal 25. So I do think investors will look through this next 12 months of investment, but it could put a cap on the stock near term after a very good run year to date.
Stefan, Kriti Gupta in New York, one of my favorite kind of lessons, I think, from Alphabet is that a success of a company is really out there when you're using the company's name as a verb instead. For example, Googling something or using Word. For example, you can't necessarily say that about AI. To what extent are the investments that you are seeing Alphabet or Microsoft invest in AI going to actually give returns? What's the timeline on that?
Yeah, well, one of the reasons we're excited about AI is we are seeing the products already. So this is why it's different than metaverse or blockchain or some other technologies that maybe are promising but are going to take longer to monetize. I mentioned Microsoft 365 Copilot. We know the pricing already. Customers are already piloting it. It should be sold, generally available by the end of this calendar year. Salesforce is another company that we like here. 100% of their revenues should be boosted by generative AI capability. Those products just went live a couple of weeks ago. And so these products are coming live. They should drive upgrades of contracts, in some cases, additional SKUs in terms of products that can be sold. And so, yes, these are big companies that will take time to come through in terms of meaningful contribution. We think that happens in calendar year 2025 for some of these early movers.
Well, then talk to us a little bit about the antitrust scrutiny as well, because now you're starting to see the AI story get scrutinized, especially in Washington. We already know that things like gaming, for example, have been heavily scrutinized by the CMA and the European Commission. Stefan, is that something the market should be pricing in, given all the green on the screen we've been seeing, or is this something you just kind of look, admire, then kind of brush off?
I certainly think it's something that the market is aware of. Obviously, when you look at the big tech players, last night, of course, we saw the FTC potentially looking to pursue a breakup of Amazon. Alphabet today, Sundar Pichai, the CEO, is in London here. We saw that last night they announced that their CFO is going to become President and Chief Investment Officer. And so the CFO, former CFO, is now going to be focused on talking to regulators and also managing that loss-making other bets business, which we think is another catalyst when Alphabet starts to crystallize value and lower losses there. So clearly the regulators are looking to slow down big tech. But as we saw with Microsoft and Activision, they're having trouble stopping them.
Yeah, I actually have that Politico story in front of me, just the first paragraph. The FTC is finalizing its long-awaited antitrust lawsuit against Amazon. People familiar told Politico, a move that could ultimately break up parts of the company. Do you think they'll be successful in that, breaking up parts of Amazon? That would be massive if that happens.
Yeah, I mean, I don't know if they'll be successful. Obviously, I do know it'll take a long time for that to play out. And so it is an overhang. We're seeing that overhang already reflected in Alphabet's valuation, where, again, there are some pursuits to break up that company. Microsoft now under a bit of pressure in Europe as well from the regulators for their bundling of teams within Microsoft Office. So all of these big tech players are under pressure from a few different sides. Of course, the flip side is it could unlock some value. So if you look at Amazon, if they do spin off AWS, then that could unlock value. But that's not what the regulators are looking at. I think they're looking more at the Prime business and some other businesses, which could actually maybe damage that flywheel effect that Amazon's so keen on.
Well, Stefan, what would hypothetically a breakup actually look like? You said it might unlock some value. What does that mean? Does it mean spinning off the cloud unit? Does it mean spinning off the logistics unit? What are the pieces that are breakable?
Well, I don't think Amazon wants to break up, and they've said that over and over again, especially Amazon Web Services. That's the obvious one that investors continue to ask about because the synergies with the rest of the business aren't as evident in terms of driving that flywheel effect for the consumer business. However, Amazon have said they're committed to kind of keeping that in-house. I think what regulators would be looking at would probably be more disruptive, which would be breaking out the Prime subscription business, for example, away from the core consumer business. And as we know, they're very closely tied.
And what does that then do to the pricing then, Stefan? We look at Amazon as kind of this proxy for the consumer, a lot of it which is traded on things like Prime Day, for example, even though a lot of their business is pivoting to things like the cloud. What does that then do for its pricing if you start to see not only a consumer slowdown, but a pricing deceleration as well?
Well, we'll see. I think Amazon Prime obviously has raised prices recently in both the U.S. and internationally. They probably do have scope to increase that more over time. So that could be something that they might look to do. But for now, I think Amazon continues to focus on trying to turn around overall profitability in the consumer business. It was break even in Q4, break even in Q1. The guidance for Q2 is for it to be break even at best. So they continue to have some profitability pressures there in that core consumer business. The other thing we're concerned about is in Amazon Web Services. You now have new competition from Oracle Cloud Infrastructure on the low end, and more competition as it comes to AI, of course, from Microsoft and Google Cloud on the high end. And so that's putting pressure potentially on margins for Amazon Web Services as well.
Stefan Slowinski of BNP Paribas Exane. Coming up, we thank you as always. Coming up, a strike avoided. UPS reaching a tentative labor deal with Teamsters Union. More on that and broader labor negotiations next. This is Bloomberg.
I'm working for the employees. I'm working to make their performance bonus bigger, and I'm working to make their plants and their engineering divisions more competitive for the midterm and the long term. So I'm working for them. That's my answer. And as long as my salary is 90% based on results, which is 90% variable, that means that if my salary is okay, then the company is okay, and that's my mission. I just would like to challenge my UAW partners to be constructive, collaborative, and open-minded in the discussions we are going to have together, and I'm sure that we can find a win-win.
Stellantis CEO Carlos Tavares there speaking exclusively with Bloomberg TV earlier this hour. Joining us now to discuss more about those recent labor discussions. The UAW is just one part of it. Ian Colgren of Bloomberg Industry Group in Washington all over that story. Look, Ian, we're going to get to the UPS in a moment, but a core piece of the UAW story is this kind of multiple tier system when it comes to wages. Now, it looks like UPS has found some sort of solution to eliminate that. The UAW did that a couple years ago. What kind of precedent is that setting for negotiations across the country?
Well, it's certainly creating some momentum, Kriti. This is something that unions have been trying to address, trying to get rid of for a long time. It's not a new idea, but it got a lot more popular during the Great Recession, especially in autos when these companies weren't doing well, needed bailouts from the government. And now unions are trying to claw back, reverse a lot of those concessions they made, which isn't easy. Once you give something up at the bargaining table, it's not easy to get it back. And it is notable that the UAW was able to do this in the John Deere negotiations in 2021. And now the Teamsters, even more notably, have been able to do this in their negotiations with UPS.
To that point, O'Brien calling this this scenario that UPS blinked. That's how he described it. Is that a fair description of how this agreement between the Teamsters, between UPS ultimately went down?
Well, certainly from what we know, UPS was the one that wanted to come back to the bargaining table. UPS has not been as open or vocal as the Teamsters have about how this whole deal went down. But when my colleague and I separately spoke to Teamsters President Sean O'Brien yesterday, he said he got a call from UPS a week ago today when he was in Los Angeles for a rally with union members, with UPS saying that they wanted to talk again. They wanted to sit down at the bargaining table. They traded proposals. O'Brien says the initial ones weren't close to what he wanted, but they were enough to get the Teamsters back at the bargaining table. And ultimately, the deal they got will get wages for full-time workers, full-time drivers, close to $50 an hour, and it will immediately get a raise for the part-time workers that the Teamsters had really been holding out to get a better deal for.
So what happens next here, Ian? I mean, we had the Teamsters president on Bloomberg television earlier this month. It's worth repeating that we, of course, have invited UPS on our air as well to talk about this. But what happens next? This is just a tentative agreement. Walk us through the timeline here ahead of the Monday contract end.
Right. Well, as you mentioned, this certainly is not done. This is a tentative agreement, which means that Teamsters members have to vote to approve it. It is a proposal that is being brought to them by their leadership, and they have to say yes, which historically has been a pretty easy win for union leadership once we've gotten to this point, but it's certainly no guarantee. You remember the rail strike that we almost had last year came about largely because members voted to reject the initial agreement that the Biden administration had broken between the two parties. And a lot of those members actually were Teamsters.
Ian, we got to leave it there simply because of time, but it's a lot to digest to your point. Ian Colgan of Bloomberg Industry Group all over it. We're going to have the Teamsters president join Surveillance in just a few moments. Stick around. This is Bloomberg.